Hello, the purpose of this video is to explain why depreciation is important to businesses and how they record it. What I'm trying to do is, I'm not just talking to accountants, I'm going to assume that there's some of you are out there that don't know how the situation, what depreciation is as an introduction to the topic. Okay. Now, if I went out and asked the average person in the street what depreciation is, they would say, my car depreciates, and that's an excellent example. Everybody knows that if you buy a brand new car and you use it for a year, and you're fed up with your car and you take it down to the local garage to try and sell it, you will not get your £20,000 back. And if you think about it, why is that? Well, the most obvious thing is wear and tear. That's the biggest cause of depreciation. The thing is not as good because you've used it. But there are other things as well. For example, there's something called obsolescence, which sounds a very big word, but basically what that means is that there are better alternatives that come along. So if I use an example of a computer, you buy yourself a computer, you know that within 3 or 4 months a better alternative will come out with probably more memory, which will perhaps even cost you less. Now, those are two very good examples of depreciation. Depreciation does cause accountants a few problems, and maybe if I go back to my car example, we can see why. If you bought yourself a brand new car, you know that you're going to have to go down to the petrol station, fill up the petrol. You know that you're going to have to insure your car, and you're going to have to get road tax. All those are expenses of driving your car. Now, if you think about it, the money that you actually spend on those things are certain. You go down to the petrol station, you know how much petrol you're going to pay for from the pump price. Road tax, well, the government gives you a list of different cars and how much you need to pay. And also, when you want to insure your car, you ring an insurance broker and they will actually tell you what the price of your insurance is. Depreciation is different. Depreciation is what is called a non-cash flow expense. No money ever changes hands for depreciation. So, for example, you might have bought your brand new car and you've used it for 2 weeks. Nobody knocks on your door on a Friday night and says, well, you've used your car for 2 weeks, it's lost X amount in value, can I have that money please? It doesn't work like that. So try and bear in mind that depreciation is what they call a non-cash flow expense. Okay, now why is this important for firms? Well, the first thing that somebody might say, do all things depreciate? And the answer is no, not in an accounting sense. We say that things called non-current assets depreciate. And you might say, what is a non-current asset? Well, a non-current asset is something that a firm buys that it wants to help them in their business to make their business profitable. They're not aiming to buy these things to sell them to make a profit on. Okay? So they buy them to help them in their business. If I use an example of a bakery obviously makes its profit from taking all the ingredients to bake bread, baking the bread and then selling it. But it wouldn't be able to do that unless it had things like delivery vans to deliver the bread, all the machines to knead the bread together, and the ovens and the provers. Now, those things are non-current assets. They last a long time. They last probably more than, well, they should last more than a year. But we know that over time they are going to lose value. So it is only non-current assets that actually we talk about depreciation. Okay. Next thing. How do we know how much depreciation is? Well, this is part of the problem for an accountant because, as we said before, it's not certain. So we've got to use ways in which we can try and estimate the depreciation. And there are a number of different ways of doing this. The first and probably the most common method is called the straight line method, okay, which I'm going to call SLN. And there's a formula to use. We take the cost of our non-current asset. Then we say to ourselves two things. how long am I going to keep this non-current asset for? So the bakery would say, okay, I bought myself a delivery van. I'm thinking that this delivery van will last me 10 years. Okay. The other thing that they say to themselves is, well, after I've used my delivery van, will the delivery van have any value? And probably it will, because, you know, even if we come to the end of the life of our cars, we can always take it down to the scrap yard and we get 50, 100 pounds, whatever it is. Now, have a look at this. I'm making the figures up, yeah? Let's assume that the cost of my, so in other words, I'll just put that, so it's cost of non-current asset minus scrap value divided by the number of years of life. Economic life, to be fair. So let's say that I bought my van for £50,000. I think, I'm just making it up, that it's going to be worth £5,000 at the end of its economic life. It must have gold in there somewhere for that price, but there we go. And I think I'm going to keep that for 10 years. So I do my little calculation. That would be 45,000 divided by 5 is £44,500 per annum, per year. I'm estimating that my delivery van will lose £4,500 a year. But look at this. There's only one thing that I am certain of. I am certain of the cost that I bought it for. But I'm not certain about my scrap value, and I'm certainly not also certain about the number of years I'm going to keep it. That's why it causes problems for accountants. There is another way that I'd like to show you, and that is something called the reducing balance method. Now, the reducing balance method basically says, we'll take our £50,000 again, over here, and I think to myself, this is going to lose 20% of its value over time. Each year, it's going to lose 20%. Where does this 20% come from? That is the estimation that the person is going to use. They use their best endeavours, they use all their business acumen to do this. No one is going to get on their case if it's 25% or 15%. They use their best thought on this. Now, of course, as I said, it's just a guess. Have a look what happens here, though. If I said 20%, okay? So here's year one, or I'll buy it for £50,000, right? I'm now going to take 20% off 50,000. So at the end of the year one, I reckon my machine, or my delivery van, is going to lose £10,000. Look what happens at the beginning of year two. It's not worth 50,000, it's only worth 40,000. I go on for another year. I'm now going to depreciate it by how much? 20%. But 20% of the 40,000, which basically means at the end of year two, it's going to be, I think, £8,000 depreciation. And I'll take that off, and at the beginning of year three, look, it's only worth 32,000. Now look at the problem here. We're saying that with this method, depreciation is going to be £4,500 a year. With this one, in year one it's going to be 10,000, this one's going to be 8,000, and so on. Different methods give you slightly different results. Is it wrong? No, it's not. The accounting authorities say that firms can use methods which suit their needs. Okay. We now come on to how we're going to record this. Okay. Now there are two very, very important, if I can just rub this off the board there, two very, very important documents where all this gets recorded in at the end of the year. One of them is called the income statement. So if I put my income statement over here, just put IS, it's divided into two parts, the trading part and the expenses part. So I've got my bakery, okay? I've got my sales, which I'm going to make up and say it's 10,000. I'm going to say the cost of baking my bread is 5,000, so I'm going to put cost here. So that my gross profit, I'm just going to put GP, is £5,000 a year. But I know that I've got other costs as well, my expenses, my running costs. This is the second part of the income statement. Okay? Now those will be things like the baker's wages, the heating and the lighting bills, but of course one of the things that has to be included as well, which a lot of people often forget about, is the depreciation. Now, what would happen, so I've got my expenses up, and I'm making it up, let's say we add them up, my expenses are 2,000, okay? I take my 2,000 off my gross profit, that gives me 3,000, which is my net profit. Great. But if I've forgotten about depreciation, this is given a false reading. If I calculate my depreciation in the methods that I showed you before and thought that it was going to be £500 for that year, look what would happen. I put my extra £500 there, that's 2,500, take it off of that, my net profit actually drops to 2,500. That is why we have to be very, very careful about recording these things. So, as I said, the income statement is done once a year and records all the expenses of a firm for that financial year. We actually we put our depreciation year upon year upon year. Okay. The other thing to notice, well, where is this done? This is done in what is called a provisions account. Each of the non-current assets will have an individual provisions account. And what will happen is at the end of the year, profit, notice not cash flow, but profit matching the depreciation will be transferred into the provisions account. Now, those of you with good memories will remember that when I did my example previously, I said that the straight line method, it was going to be £4,500 per year. So look, after year one, I would be putting £4,500 worth of profit into my provisions account, and that I will record in my income statement. Second year, what would happen? I would transfer another £4,500 from my profit and put it into my provisions account. Okay? Imagine this is the second year of my income statement. How much goes in there? Well, it's still 4,500. Why? Because that year's depreciation is still the same. It's 4,000. We're looking at each year. It's £4,500. Okay. But you might say, we've got a sort of problem there. Because look, we put 4,500 there, 4,500 there. If I add those up, it comes to £9,000. What happens to that? Well, that's the second important document that this gets recorded in. There's something that a lot of you might have heard of called a balance sheet. And a balance sheet, again, is done once a year and is linked to the income statement and shows the net worth of the business, how valuable it is. I'm just going to look at one tiny part of that, and that is the non-current assets. So I'm just going to put NCA, which is my non-current asset. Okay. Remember, we said in year one, we went out and we spent £50,000 on a delivery van. This will be done, the balance sheet will be done at the end of the financial year. So what we would do, right? Cost of van. Well, the cost of the van is £50,000. Let's put pounds on there. What happened? Well, at the end of the year, I had to take £4,500 off for depreciation. I've recorded that in my income statement, but I also have to record it in my balance sheet. Less depreciation, 4,500. Okay. If I take that off, okay, what do I get? I get 500. I think it's 45,500. That's called net book value. That's a technical term, net book value. All it means is what you think that thing is worth at that time, because there'll be a date up there, normally at the end of the financial year. So let's roll it on another year. Okay, I say the second year, okay, for the income statement, the depreciation is still 4,500 because that was the depreciation that's matched to that particular year. But look what happens in my balance sheet. Obviously, we've got a different balance sheet here, right? So we have non-current asset. Cost of van. Well, the cost of the van is still £50,000. We bought it, whenever we bought it for £50,000, no argument about that. But look what happens. We get 2 years of depreciation built up. The balance sheet shows the cumulative effect of this. Okay? So we put less. In fact, technically we put less provision for depreciation. Yeah? But I'm just being a bit lazy. But it would be 9,000. Now look what happens here. My net book value, what I think it's worth, is now 41,000. Right? I stress that this is a guess, it's not certain. It's not certain at all. But look what's happening. As the machine, or in this case the van, is getting older, we're recording that the thing is not being, it's not as valuable as it was. Now just imagine that you had your bakery and that you wanted to sell your bakery for whatever reason. Okay? So you get interested parties in. Okay. What's the first thing that they're going to ask for? Well, they're going to ask for a copy of your income statement to have a look at your profits, but also they're going to look at your balance sheet. And what they're interested in is things like the value of your fixed assets. Now, no one is going to actually force them to do this, but you can start making some judgments here. If, for example, you know when something's becoming older, because the cost of the van, 50,000, in a few years' time, if we carry it on, depreciation might be 45,000, leaving our net book value, what we think is 5,000. So it's given an indication that, oh yeah, we spent £50,000 on our van, but now it is only worth 5,000. And that is the purpose of recording depreciation. Okay? But again, just final point, okay? Depreciation does cause a few problems, but the thing to remember is that it is not certain. It's what they call a non-cash flow expense. And the only time that you will find out how much the depreciation really is when you come to sell your van. That's the only time. And you might say, well, what happens if you haven't built up enough profit? Well, you just take a little bit more out. You record it as a paper loss. What happens if you've taken too much profit? Well, basically, you just pay it back in. It's called a paper profit. Thank you very much.